to use the chat box to introduce yourself and let us know where you are logging in from. Hello, can you hear me, please?
How much for that one? Hello, 400.
Hello, everyone, and you are welcome.
Hello, good afternoon. We can hear you, but there is a terrible noise at the background.
Hello, can you hear me? Hello, everyone.
Hi, good afternoon, sir.
Good afternoon. Hello, you are welcome.
Can hear you.
Good afternoon, sir.
Good afternoon.
Yes, we are giving a few. Yes, we are giving a few moments so as everyone can join us. I can see different participants logging from different directions, different locations. While we are waiting, feel free to use the chat box to introduce yourself and let us know where you are joining us from. We soon start. Please, your name, your direction, so as not to forfeit your 2 credit units. Thank you. Good afternoon once again. Please, can you indicate if you can hear me? Hello, good afternoon once again.
Good afternoon, loud and clear. We can hear you.
Good afternoon.
Thank you very much.
Thank you.
Good afternoon, everyone, and warm welcome to Sokoto District Society webinar. We are happy to have you with us today. My name is Bello Gane Oleke, and I will be your moderator for this session. We are here today to discuss Nigerian tax reform and digital compliance, how accountants and business can adopt. We have a speaker who is motivated expert for you. Before we start, let's have a housekeeping items. That is the rules that guide us. Please, question. We encourage you to ask questions throughout the webinar. Chat. The chat is available for us for comment and networking. And finally, questions are also available at the end of the section. Before them, please, let's have national item and ICANN item.
Sorry, moderator, the audio is not coming. Hello?
Hello?
The audio, we're not picking the audio. It's not speaking out.
There's no audio.
Okay, please, Mr. Secretary, please, can you assist?
Okay, just take this down. Let me share my screen. Let me share it from here. Okay. Just a minute.
Nigeria, we hail thee, our own dear native land. Though tribe and tongue may differ, in brotherhood we stand. Nigerians old and proud to serve our sovereign motherland. Our flag shall be a symbol that truth and justice reign. In peace or battle honored, and this we count as gain. To hang on to our children a banner without stain. O God of all creation,
dwell in harmony, building our land together. Dreams of a founding fathers, we are striving to attain our roots and values that we share through all ages be sustained. Institute of Chartered Accountants of Nigeria, noble like and noble like and your accuracy we cherish. We uphold your integrity.
Thank you very much, our secretary. Please note the following: recording. This webinar is recorded. It's being recorded, and the copy can be read or will be sent to you. Also note that the webinar is also broadcasted on our website for those who will not be able to join us. Please, we need to call our chairman without further delay to give us opening remarks. Alhaji Ganeyo A. Mustafa, HND, BSc, MBA, ANIM, ICT, ACA. Please, kindly give us opening remarks.
Thank you so much, my technical secretary. Am I audible?
Yes, we can hear you.
Loud and clear.
Okay. Thank you so much, my technical secretary and my general secretary. Good afternoon, council members here present, our district coordinator and professional colleagues around the world. Good afternoon to you all. It's my greatest honor and privilege to welcome you to this important webinar on Nigerian tax reform and digital compliance, how accountant and business can adapt. As we navigate this era of rapid digital transformation and evolving fiscal policy, the role of accountant and business leaders has never been more critical. Today's discussion is not just about understanding the reform, it's about strategizing for resilience, embracing innovation, and ensuring compliance in a way that drives sustainable growth. The federal government push for digital tax administration presents both challenges and opportunity, and it is our responsibility to stay informed, agile, and proactive. And it is on this note, Sokoto and District Society deem it fit to bring to your attention this afternoon on how we can stay compliant and still involved in our leader in our business. Our presenter today is erudite scholar, Professor Kennedy. I bet you after this webinar, you will not regret having him. Please, I encourage you, let's engage, ask questions, collaborate, because the future of tax compliance in Nigeria is being shaped by conversation like this. Thank you so much, everyone, and I wish all of us a very fruitful and enlightening session. Thank you, and God bless you. Over.
Thank you very much, Mr. Chairman, for a brief opening remarks. We appreciate that. Please, let's have a brief introduction of our presenter today, a person of Dr. Kennedy Owondu.
Profile of Dr. Kennedy Owondu. Dr. Kennedy Iwundu Chinyere is an associate professor of forensic accounting and fraud management studies in ICT University, Cameroon. He has PhD in forensic accounting and audit from Charisma University TCI, United Kingdom, UK. He is a fellow of the Chartered Institute of Taxation of Nigeria, CITN, associate member, Certified National Accountants, CNA, fellow of Association of Certified Chartered Accountants, FCCA, associate member of the Chartered Institute of Forensic and Certified Fraud Investigators of Nigeria, CIFIN, fellow of the Certified Fraud Examiners, CFE, fellow of Forensic Accounting Researchers, FFAR. Dr. Kennedy Iwundu is the managing partner of Accounting Tools Consulting Services and one of the tax advisory partners of Emmanuel Oswagwu & Co., chartered accountants, tax consultants, and forensic auditors. He is a director on the board of the Chartered Systems Tax Professionals, USA, and is also a founding member and a member of the Board of Trustees of Federal Capital Territory, FCT, Nigeria's Tax Practitioners Association. He is also on the board of Association of System Tax Professionals, Nigeria. Dr. Kennedy Iwundu is a director in OGE Professional Services, director in Association of Certified Information System Accountants, ASISA, director on the board of trustees of GLAM Trust Foundation and founder/director board of trustees of Kennedy Iwundu Foundation. He is a past chairman of the FCT Tax Practitioners Association, FCTTPA. He is the immediate past chairman of the Chartered Institute of Taxation of Nigeria, CITN, Abuja District and Society. He is a member of Audit Qualification Committee of the Financial Reporting Council, FRC, of Nigeria 2025. He is also a member of Research and Technical Committee of the Chartered Institute of Forensic and Certified Fraud Investigators of Nigeria. He is a multidisciplinary professional. He has 18 years consulting experience in accounting, auditing, forensic, and tax services. Dr. Iwundu is an author of many books, seminar papers, and research publications in forensic accounting, auditing, and taxation. He was at one time students' private tutor at various institutions including Imo State University, Federal Polytechnic Nikede, University of Port Harcourt, and Institute of Management and Technology, IMT, Enugu. Thank you all for listening. He is a multidisciplinary professional. He has 18 years consulting experience in forensic and tax services. Dr. Iwundu is an author of many books, seminar papers, and research publications in forensic accounting, auditing, and taxation. He was at one time students' private tutor at various institutions including Imo State University, Federal Polytechnic Nikede, University of Port Harcourt, and Institute of Management and Technology, IMT, Enugu. Thank you all for listening. Profile of Dr. Kennedy.
Thank you very much. Please join me to welcome Dr. Kenneth Iwundu to Sokoto District. You are welcome, sir.
Thank you for having me. Thank you for the second missionary journey. I think I was in Sokoto before.
Thank you very much, sir. We will still call you more and more, sir.
Thank you very much. So you can give me an opportunity to share the slide. I think I have it.
Okay, sir. Yes, sir. We do that now, sir.
Okay. Can you see the slide?
That's right. Yes, you can share.
You can do that, Prof.
Okay, thank you very much. Professional colleagues, it will be a very wonderful time for us to look at the current tax law so that we get ourselves equipped against next year when the implementation of this law will start. They say ignorance of a law is not an excuse. So some of us, especially those who are practicing, even if you're not practicing, but you're a chartered accountant, you deserve to understand what the tax laws are saying so that when people ask you questions, some basic questions, you can be able to answer them. You won't tell them, I don't know what the new tax law is talking about. So please, I'm sure at the end of this lecture, you're going to enjoy this and we'll be able to entertain all questions that comes with it. So I'm going straight to the introduction because of time. In the introduction, we are talking about Nigerian Tax Act. Recall that there were four. There are four of them. We have the Nigerian Tax Act, Nigerian Tax Administration Act, the Joint Revenue Board Establishment Act, and the Nigerian Revenue Service Establishment Act. But today, we are looking purely at the Nigerian Tax Act, where we have all the laws. And what is Nigerian Tax Act trying to tell us? They just decide to compress the whole act, the whole Tax Act, into a single legislation. We won't be having company income tax different, personal income tax act different, value-added tax act different, stamp duty act different. No, they just brought all of them into one single legislation. That's why they call it a unified legislation. The Nigerian Tax Act can be called a unified legislation. How did they come about it? We are going to find out how they come about it. But before then, let's look at the conceptual framework of taxation in Nigeria. I want to remind everybody again that payment of taxes is backed up in the Constitution by the Section 24F of Nigerian Constitution. It provides that it shall be a duty of every citizen to declare his income honestly and make sure that he honestly pay tax to the appropriate agency. Also, Section 44, subsection 2 of the Constitution of the Federal Republic of Nigeria made it clear that imposition of taxes on citizens does not amount to an infringement of their right to own property, but it's a necessary exercise of governmental power, especially government trying to generate revenue. So we should understand that it's in the law. Look at those sections, Section 24F and Section 44, subsection 2. So these are our conceptual framework. So some people who argue, government is not doing anything, we will not pay tax. You should know that in the Constitution, we say we should pay tax. And our duty is to pay this tax and then fight government if they are not doing what they are supposed to do. Now, I have to go into my own conceptual framework. I have a conceptual framework which I called the quadruped of taxation. The quadruped of taxation. And under this quadruped of that, you can see the quadruped of taxation by Dr. Kennedy Wundu. What are those 4 legs taxation is standing on? Here, I try to show you the 4 legs taxation is standing on. You have the tax policy, you have the tax legislation, you have the tax administration, I have the tax jurisprudence. The tax policy guides the tax legislation, and the tax legislation guides the tax administration. Then the tax jurisprudence interprets what the administration and what the law is talking about. Now, let me give you an example. The tax policy is a guiding principles established by government on collection of taxes, while legislation is the body of laws. Then administration is just implementation, ensure that necessary assessment, returns, collections, investigation, enforcement are done. Now, let me give you an example. Nigeria has a tax policy that says we need to encourage small businesses in the country. Now, we are making a law to say small businesses will not pay tax. You can see how the tax policy is guiding our legislation. And during administration, the tax administrators will not collect money from those small companies. You can see how these things are moving. We also have a policy that talk about progressive taxation. Now, if we have progressive tax, you can see the laws are now making that those who earn more will pay more. So you can see that laws are being built in line with the policy. And based on that law, those tax administrators, whether it's Federal Revenue Service or the state, will follow the spirit of the law. Then in jurisprudence, where the tax administrators are not doing the right thing, the tax jurisprudence, the judge, the court will interpret the law in line with the administration. And if they did the right thing, you say, yes, they did the right thing. And if they don't do the right thing, the court will say, no, what they did is wrong, especially when the taxpayer takes the tax administrator to court. Now, let's go straight to the objective of this act. The objective is simple, is to unify fiscal legislation governing taxation. It's a unification, as I said before. So many taxes are brought into one framework. You don't have company income tax, capital gain tax act, value-added tax act separately, personal income tax act separately, stamp duty act separately. All these acts are being unified into one single legislation. This is exactly what the committee did, and I commend them. They did a very wonderful job. Now, under the legal framework, you can see that from the time this tax act will commence by January, the following of these acts are repealed: capital gain tax repealed, Casino Act, company income tax, deep shore industry. You can have the list of the tax act have been repealed. How many of them? There are about 12 of them. Can you see them? There are about 12 of them. Stamp Duty Act, Taxes and Levies and Public Collection, Value Added Tax Act, Venture Capital. All these acts has been repealed. So from next year, nobody will be quoting Company Income Tax Act. Nobody will be quoting Capital Gain Tax Act. Nobody will be quoting Value Added Tax Act. They all be repealed. Now, the law also amended the following. These are the ones amended. You can see the list of the amended acts. These amended acts are up to 13. You can see them. You can see them. They're up to 13. They have been amended. So now let's go to the act itself. I was able to identify 18 key changes. Why I said key changes, we are looking at what is now different from what we have before. We don't need to waste our time and talk about what they kept, what we are doing before the act we do now. But we are looking at those things we are going to do from next year, which we are not doing before. And that's why I said there are top 18 key changes in the act. Number one, we look at the tax rate under company income tax. Under the tax rate, small companies that has turnover from 0 to 50 million, the tax is 0%. The tax rate is 0%. While companies that have 50 million and above in a turnover in a year, the tax rate is 30%. Is that clear? Now, there's a proviso. A small company means company that earns gross turnover of 50 million or less per annum, with a total fixed asset not exceeding 250 million. So what is they trying to say? If your company has a turnover of 50 million or below, but your asset exceeded 250 million, you are no longer a small company. That is exactly what this is talking about. So if you have a company from next year, after end of 2026, when you are filing 2027 returns, and your turnover, the turnover of your company is 50 million and below, the tax rate is 0%, means that you have no tax to pay. However, if that your company has assets that is more than 250 million, is no longer a small company, you will pay tax. So let us understand it as we move on. The same provision talked about a minimum tax of 15%, but this time around, is talking about companies that constitute entity of a multinational enterprise. A multinational enterprise, you know what a multinational enterprise, that a company that has branches or presence in so many countries of the world. So if you are a multinational enterprise, especially with an aggregate turnover of 20 billion and above, that you have to pay a minimum tax of 15%. And that is exactly what the act is talking about. Now we move to the one we talk about imposition of tax on income, profit or gains. Here is trying to say any gain made by any company will be subjected to 30%. Recall that prior to this time around, if a company makes a gain, possibly on the disposal of assets or realized exchange gains or whatever, we normally subject that companies to a capital gain tax of 10%. But the new act is no longer seeing the gain, that the gain should be taxed at 10%. The new act is saying that gain should be taxed at 30% company income tax rate. That indirectly, what the new act is saying is that capital gain tax has been abrogated. The new act is trying to tell us capital gain tax gone. Any gain you made, you apply tax rate on it. Or like before, when we have capital gain tax, if a company disposes an asset or been able to sell shares or whatever, if there's a chargeable gain from the disposal, you charge it under 10% capital gain tax. But in the new law say no more charging gains under capital gain tax at 30%. Whether you are an individual or you're a company, once you make a gain will be subjected to income tax. So what the new law is indirectly telling us that capital gain tax gone. Any gain you made, income tax will apply on it. Now, we also have there is a restriction on small business. This doesn't include professionals like us who will register our firm to run tax professional services or audit or accounting services, lawyers, doctors, and all that. So the new law says that for those who enjoy that 50 million turnover, companies that will enjoy 50 million turnover and below, professional services are not included. Professional services are not included, even if you intentionally go and register your audit firm as a limited liability company. When the Revenue Authority sees that they're using it for audit services, they will remove you. You're going to pay tax. So let us make it clear now. Professional services, audit services, legal services, medical services, architecture, engineering, all those professional services, they are exempt. They are not part of this 50 million threshold of companies and below. They expect us to run our business using business names. And I know that ICANN and other professional bodies also have stopped giving license under limited liability company. In fact, some people that have been given licenses under limited liability, they have even been asked to return their license and register a business name. So that's why professional services are carried under business name. It's assurance services. You need to assure your client of quality of work. You can't register a company and say, my company is different from me. So you can sue my company and they can't sue me. No, it's you. And you are rendering assurance services. So when they sue your firm as a business name, it's you that they sue. And that is how it's supposed to be. So if nobody can also exempt business name. If you exempt business name, that means you have exempted the individuals not to pay tax. But if you exempt companies not to pay tax, you have not exempted the individuals who own those companies not to pay tax. So that is a very clear deal. So the next one here is the elimination of minimum tax on loss-making company. In our current law, that's on CITA, Company Income Tax Act, Section 33 is trying to say that if you make losses, as far as you have operated up to 4 years and your turnover is more than 25 million, you pay a minimum tax. That's what our current law is doing. If you file your returns on tax from us, you can see that there's a minimum tax you're going to pay, even when you claim you made loss. But the new tax law under Section 27, subsection 1, says no, any company that genuinely made loss will not pay minimum tax. And it's a very good one. So our new law said no more minimum tax. If a company genuinely show that they have made loss, they shouldn't pay any minimum tax, unlike what is currently going on, where a company will make loss and still pay minimum tax. But I want to advise professionals here that don't say because the law said that if you make losses, there's no minimum tax, you as an auditor will be declaring losses for companies. Please don't do that. Any company that wants you to declare loss, ensure they have the document. They have the books and records to prove that they actually made genuine loss. Some firms will come to you, some companies will come to you, please, we made loss. Just prepare an account and say we made loss so that we won't pay tax. As a professional, I'm advising you don't do that. It is unprofessional if you do that. If any company comes to you, say, now we can declare loss and no tax to be paid. Tell him, bring me your documents. Show that you have expenses, you have cost, that if I compute it, it shows that I've made loss, that your cost is more than your revenue. And once you be able to prove that to me, then I'll prepare my account and declare that you made loss. So I want us to remember that we need to show professionalism in what we are doing. So the next one is, please be noting down any of these points I'm making, so that if you want to ask question on that point, you can go straight to that point and ask question. Then the next one is the general principle for tax deductibility. The Section 20 of the Nigerian Tax Act outlines the type of expenses that may be deducted when determining taxable profit. Subsection 1 specifically stated that such expenses must be wholly and exclusively incurred in the production of income to qualify for deduction. Formally or currently, additional principle of reasonably and necessarily incurred are no longer applicable. So the new tax law has removed or has eliminated the principles of reasonability and necessarily. So meaning that we only have two. Remember that we have them before as 4, but now the new tax law retained 2 and eliminated 2. What we have now is wholly and exclusively, while reasonably and necessarily has been eliminated. So we should know that very well. Then another one is Section 60 of the Nigerian Tax Act. The Section 60 is looking at specialized business like lottery and gaming businesses are treated as specialized sector, subject to a corporate tax standard of 30%. Before now, there have been confusion if gains made on lottery should be charged under company income tax or capital gain tax. For this clear now, the new law says that any gain made by lottery, by gaming, by any form of, that gain will be charged under company income tax if it is a company that made the gain. But if it's an individual, it's also going to be charged under income tax of individual. No more. That's why I said the new tax law has totally eliminated capital gain tax. Before now, there was a confusion. Those into lottery and gaming business, what would they be paying? Are they going to be paying capital gains on their gain, or would they pay company income tax on their gain? That's confusion. But in the new law has made it very clear. You can look at it as Section 62 of the Act. It made it very clear that those companies, those individuals into lottery, gaming business, any gain they have made will be charged to income tax. Please be noting these things so that now another point here is a deduction for research and development. Currently, deduction to be deducted under CITA is 10% of total profit. CITA company income tax, which we are currently operating, says if you have gains, if a company has gains, profit, when you are making donation for research and development, you can only donate 10% of your total. You can't donate more than 10% of your total profit. But our new law now under Section 162, subsection 2, say that you can donate up to 5% of the company's turnover, meaning that there's more donation going into research and development. The government just wants to encourage that more money should be donated for research and development. Research and development need so much funds, and government want to use this way to encourage companies to fund research and development by saying, no, from now on, in the new law, you can donate 5% of your turnover. Unlike before, you can't donate more than 10% of the total profit. I hope that's clear. Yeah, let's move to the next one. These are very interesting changes, and I want you people to note some of these interesting changes for questions. Now, the next one is taxable profit of non-residents. The Nigerian Tax Act expands the scope of the activities of non-resident companies that are subject to tax in Nigeria. Notably, the Nigerian Tax Act introduced force of attraction rules. Under these rules, certain activities carried out by the non-resident company or its related parties can be taxed as part of the non-resident company's permanent establishment, PE, in Nigeria, even if those activities are not physically conducted through the permanent establishment. In addition, profits from engineering, procurement, and construction contract can be taxed in Nigeria, even if some of the activities are performed under separate contract or outside the country. So this is one of the additions they have done. We also have a minimum tax for non-resident companies. Non-resident companies who have a taxable presence in Nigeria will now be subjected to minimum tax base on the percentage of their earning before interest and tax to total income generated from Nigeria. In case of tax payable by such company cannot pay less than withholding tax rate applicable to income tax or 5% of the income. Also see Section 51 subsection 8 of the Nigerian Tax Administration Act 2021. So this is what they're talking about, minimum tax of non-resident companies. So now non-resident company has a minimum tax, and it is very clear that they have. And also they say expenses of non-resident companies in foreign currencies are deductible only at official CBN rate. So no non-resident company will be telling us its expenses on black market rate. It won't be acceptable. Expenses of non-resident company will be at CBN official rate. And use of earning before interest and tax from financial statement or profit determination, or if unavailable from comparative or comparable companies. Now, we also have another point, which is about control foreign companies. The Nigerian tax law tried to recognize that there are Nigerian companies that are controlling companies that are not in Nigeria. They are Nigerian companies. They are controlling, they have shares in companies that are outside the country. And they are saying that if you have a Nigerian company that has shares, that has equity in any country that is outside Nigeria, that country, they have equity that is outside Nigeria, when they share dividends to Nigerian company, those dividends or those profits they are sharing must be taxable in Nigeria, since it is a Nigerian company that is controlling that. We don't have this before. We don't have this before, but they are bringing it. So the Nigerian Tax Act imposes tax on undistributed profit of foreign companies controlled by Nigerian companies, where it is considered that the foreign subsidiary could have distributed dividends without harming its business. The introduction of control foreign corporation rules is to counter profit shifting. The objective of the CFC rules is to prevent such tax deferral by extending the residency tax rule to the income of the foreign subsidiary. So under the rules, undistributed income of a foreign subsidiary company is attributed to the resident shareholder and taxed as if profit has been distributed. You can see that in section 6, subsection 2 of the Act. Then we also have development levy. You know, the Nigerian Tax Act tried to introduce what we have, development levy. We don't have this development levy currently, but from next year, development levy will come. You can see development levy on section 59 of the Nigerian Tax Act. Section 59 of the Nigerian Tax Act. So section 59 of the Tax Act imposes a 4% on the accessible profit. The section 59 of Nigerian tax imposes a development levy, and that development levy is 4% of the accessible profit. I hope some of us know what is accessible profit. Who can tell us what is an accessible profit before I continue? Somebody should tell us what is an accessible profit, where this development levy of 4% will be imposed. Just one person should unmute and tell us what is accessible profit. And what's the difference between accessible profit and total profit? Can somebody answer that question before I continue? Okay, let me go ahead.
Bro.
Yeah, go ahead. You want to say something?
Yeah, accessible profit refers to the profit of the company before that is subject to tax before deducting the capital allowance.
Yeah, thank you very much. The accessible profit is that profit when you disallow some of the disallowables and add it to the net profit before tax, you get accessible profit. You know, you normally have profit before tax. Now, during tax, when you compute your tax, there are certain things that are not allowable, like depreciation. Depreciation, provision of depreciation is a non-cash item, so it's not allowable. Depreciation, amortization, impairment of assets, all those provision for bad debts, all those, there are so many things that the tax law don't allow. By the time you add those things back to that profit, you get what we call accessible profit. But by the time you charge your capital allowance on that accessible profit and do your deductions, you now have the total profit. So we should know the difference between accessible profit and the total profit. So this 4% development levy goes to the accessible profit. And when it gets there, it goes to a fund. Inside that fund, Out of that money, out of that 4% development levy, third fund will take 50%, half of the money. Nigerian Education Loan Fund will take 15%. NIDA, National Information Technology Development Agency, will take 10%. NASENI, National Agency for Science and Engineering Infrastructure, will take 10%. National Cyber Security Fund will take 5%, and Defense Security will take 10%. So this is exactly how it will be done. They didn't talk about police levy. Remember that currently we are doing police levy. That means police levy has been abrogated or eliminated. Now, what are we practicing? What we are currently practicing is education tax is 3% of the assessable profit. NIDA is 1% of the profit before tax. NASENI is 0.25% of profit before tax. And police levy is 0.005% of profit. This is exactly what we are currently practicing. So by next year, these things will no longer be in practice. It will be eliminated. So we expect that the federal government will set up development levy allocation committee where monthly meetings of allocation will be held. Representatives of NIDA, TED Fund, NASENI, NER Fund, Office of National Security Advisor, Ministry of Defense, we gather and share money, share this development levy the way they are sharing FAC every month. Now let's go to personal income tax. Personal income tax. Here, there's a new thing. The personal income tax eliminated consolidated relief and introduced rent relief. You can see that on section 30, subsection 2VI of the Nigerian Tax Act. So I'm quoting these sections. The reason why I'm quoting all these sections is that when you get this section, you can quickly go to the act and cross-check that is where I'm quoting from. So section 30, subsection 2, VI of the Nigerian Tax Act has eliminated consolidated relief and introduced rent relief. Recall that consolidated relief is 20% of their total income plus 200,000. Now, from next year, that will not work again. What will work is rent relief. And what is rent relief? Rent relief is 20% of annual rent paid, subject to a maximum of 500,000. Meaning that if somebody claims his rent is 1 million a year, the law will grant you 20% of that 1 million, which is 200,000. If somebody claims his rent is 2 million in a year, the law will grant you 20% of 2 million, which is 400,000. If somebody claims his rent is 500,000 in a year, the law will grant you 20%, which is 100,000 naira. But they said that rent relief, the maximum they can grant you, even if your rent is 20 million, is 500,000. Assuming that your rent is 10 million, 20% is 2 million, Abi, they will not grant you 2 million, rather they will grant you 5 million naira. And the revenue authority will be sure that you present evidence of the rent payment or rent agreement. And not only that, this rent relief is only applicable to tenants. Landlords are not tenants. So you can't be a landlord and be telling the revenue authority to grant you rent relief. Landlord, do they pay rent? Landlord don't pay rent. So before, a landlord is being granted consolidated relief. Before, a landlord benefits from that consolidated relief, but that consolidated relief is for everybody. 20% of total income plus 200,000. So everybody gets it. But now, they say it's for those who are paying rent. So if you are not paying rent, if you are squatting in somebody's house, or if you're a landlord, I'm very sorry that rent relief will not be for your benefit. And these are the new rates. This is the new rate. The new rate for the personal income tax. The first 800,000 is 0%. Next 2.2 million is 15%. Next 9 million is 18%. Next 13 million is 21%. Next 25 million is 23%. And income above 50 million is 25%. So what they have done now is to say big men who are earning more income, you have more tax to pay. That comes in line with our tax policy of progressive taxation. The higher you earn, the higher you pay your taxes. Now, I made a note today. I said chargeable gains shall be taxed at income tax rate. Currently, if a man, currently as we are today, if you make a gain of 100 million from disposing your property, such gain will be charged under capital gain tax of 10%. That's all. But in the new law, if you make a gain of 100 million, that 100 million we charge on this rate we are looking at. That means you're going to pay more. Is that clear? Currently, if you sell your house and make 100 million, you pay only 10% capital gain tax currently as we are today. But from next year, if you sell a house and make 100 million, you're going to pay, or this rate will follow. You're going to pay this rate, it will be higher. So that is that we are going. So they want to see a way they can get more money to run the government. Now, the also requirement for employees to file returns. Now, the employees will not only say that they're filing your returns based on the money they're paying you, they also will expect you to fill a form and let them know they are not making any other money. You know, those who are working in companies and government agencies, they only file returns of the money they are receiving as salary. But some of them may have other money coming. They're not reporting those money. So the company that you are working will now give you a form. So please write in this form, you are not making the money. Apart from salary we are giving you, are not making extra money. You now sign for them, you are not making extra money. So that when they catch you that you made money outside your salary, it will be your problem. It will be that company's problem any longer. You know? So, and then when the Revenue Authority catch you, the company will show them that you signed to them that apart from the salary they are paying you, that you are not making any other money. So that's why they have to file the only salary that they are paying you. But in Nigeria, nobody files returns more than the salary they are paying him. Even if you have a house, you are collecting rent, they will tell you that one no be government money. That one is my private money. I'm not going to include that one. I lie. So that is what the payee is saying now. Then we also go to emolument of Nigerian unemployment performed on foreign country or international organization that is not subject to tax in another country. Under the agreement or diplomatic arrangement to which Nigeria is a party, will now be taxed in Nigeria. What are they saying? If the federal government send you in as a diplomat to US and all your allowances being paid there in US is not being taxed because of the diplomatic relationship Nigeria has with US, government is saying those allowances that are paying you there that is not taxed in US, they will not tax it in Nigeria. That's what the new law is saying. So let us understand this law very well, because there are so many things in this law many people don't know. But I'm sure by next year when they start the implementation, all of us will understand it very well. The tax on individual employed by Nigeria, employees of Nigerian government will now be taxed in Nigeria if they are not subject to tax in any other country, irrespective of exemption under agreement or diplomatic privilege. So if you are working as a diplomat in Congo and Congo is not taxing the income because you're a diplomat, Nigerian government is saying that income Congo is not taxing there, they will not tax it in Nigeria. Now, we also look at the due date for payee income tax return. You know that 31st March as a due date for personal income tax return has been eliminated. There is no longer 31st March. Everything depends on your returns, depends on when you choose your accounting date. You can see that in section 13 of Nigerian Tax Administration Act. However, due date for payee remains 31st January. You can also see that in section 14 of Nigerian Tax Administration Act. So let us know that very well, that due date for payee return is 31st January, but for PIT is no longer 31st March. So we should know that. But for monthly remittance of payee remains 10th of every month. Now I did an illustration to show the impact of the new tax on low and high income earners. Now I have illustration here, Group A and Group B. Group A that earns 1 million. OB earns 5 million. Amina earns 10 million, and Shegu earns 15 million. Obong earns 20 million. Then in Group B, Obong earns 20 million, Kenneth earns 30 million, and Juliet earns 40 million, Evelyn earns 50 million, and Patrick earns 100 million. We are going to do computation based on the current rate and also based on the new tax law. We are going to do based on Peter. Peter is the current tax we are applying to the Personal Income Tax Act, and we're also going to do based on the new tax act. So if you look at the Group A personal income tax computation, for that under currently that is any 1 million is paying 54,000, but from next year under Nigerian Tax Act, that will not pay anything. Then OB that is earning 5 million currently is paying 704,000. By next year under the Nigerian Tax Act, OB will be paying 654,000. Amina that is earning 10 million under the current personal income tax is paying 1,664,000. Amina next year under the Nigerian Tax Act will be paying 1,554,000. Then Shegu that is earning 15 million currently is paying 2,624,000. By next year, Shegu will be paying 2,538,000. Then Obong that is earning 20 million currently is paying 3,584,000. Obong by next year will pay 3,588,000. You can see at this point of 20 million, most of the two laws are almost at equal. So let's look at those who are earning higher. Let's look at Obong, and we have said Obong before. Obong is earning 20 million. It's currently paying 3.5 million, and under the Nigerian Tax Act is 3.5. Let's look at Kenneth. Kenneth is earning 30 million. Currently, Kenneth will be paying 5,480,000, but for next year, Kenneth will pay 5,784,000. Juliet is currently earning 40 million. Under the new law, Juliet is paying 7,376,000. By next year, Juliet will be paying 8,084,000. Evelyn is earning 50 million. Currently under the Nigerian tax law, under Peter, Evelyn is paying 9,272,000. By next year, Evelyn will be paying 10,384,000. And Patrick, who is earning 100 million in a year, currently Patrick is paying 18,752,000. By next year, Patrick will be paying 22,880,000. You can see that the new law is trying to take more money from those who are earning higher, and thereby reducing money for those who are earning low. And the threshold is 20 million, you can see there. Now let's look at the capital allowance. Capital allowance. There's removal of initial allowance on capital expenditure. Companies can no longer claim capital allowance in their first year of putting assets to use, leading to higher initial tax liability and reduced cash flow. This particularly impacts capital-intensive business, as tax relief on asset purchases will now be spread over time. However, the amendment in Section 27, subsection 4, which allow business with non-taxable income below 10% of total income to fully utilize their capital allowance, provides some relief. Small companies can now claim full capital allowance without proration, reducing taxable profit and CIT obligation. While capital-intensive business face delayed tax relief, this adjustment ensures that SMEs with minimal non-taxable income can maximize tax deduction on capital investment. So look at the new qualifying expenditure rate. The new qualifying expenditure rate on capital allowance is 10% for building expenditure, agricultural expenditure, mass expenditure, intangible assets expenditure, and heavy transportation. You also have the 20% for plant expenditure, agricultural expenditure, equipment, furniture and fittings equipment expenditure, mining expenditure, other expenditure, or other equipment. Then you also have 25% for motor vehicle expenditure, software expenditure, and other capital expenditure. So these are the new rates for capital expenditure. So formerly, we normally have 50%, or currently we normally do 50% initial allowance for motor vehicle and 25% for annual allowance. Now, there's nothing like that. From next year, we are going to do just flat single rate of 25%. Now, let us take a note. I want to take note of these issues. One, unutilized capital allowance on assets sold or transferred shall not be available for use in the new or surviving trade or business. Unabsorbed losses of the old business shall not be available for use in the new or surviving trade, business, profession, or vocation. So we should know that very well. Also, the lessor, that's the hirer. If I'm the one leasing my asset, I'm not eligible to enjoy capital allowance. The person that will enjoy is the person that will lease that asset to. So please, we should note it. The lessor, that's the hirer of an asset, is not eligible to enjoy capital allowance on asset. Capital allowance is to be enjoyed by the lessee, the person who have taken over the property. If I lease my tractor, I have a tractor worth 200 million, I lease it to somebody for 10 years. Myself that gave as a lessor, I'm not supposed to be entitled to the capital allowance. It is the lessee, the man have leased that tractor, that will enjoy the capital allowance. You can see that in part 1, first schedule, part 1, section 15, subsection 2 of the Nigerian Tax Act. So we should take note of some of these things. Another important thing about the capital allowance is that where VAT or import duty was not collected on that asset purchase, such assets will not be qualified for capital allowance expenditure. You can see that on section 2P of Nigerian Tax Act. So please, tax consultant, chartered accountant, take note. If our client buy asset, we should ensure that the receipt of that asset, that VAT was collected on that receipt. They are saying that if our client buy asset and VAT was not collected on that asset will not qualify for capital allowance. We're going to have tough time next year. So we have to start now to tell our clients to ensure that every receipt that VAT was charged and is included in that receipt, for that asset to be qualified for capital allowance. Otherwise, FIRS, when they are doing audit, or when you file your return, say, no, we are not going to allow you to claim capital allowance on this asset because you receipt you brought, they didn't charge VAT on the asset. So it's time now for some of us to start educating our clients. You know, Nigerians are very stubborn. They'll tell you, don't worry, when we get to the bridge, you cross it. And when we get to that bridge, to cross it becomes difficult. We start begging the revenue authorities who came to do audit. You know, so many things will be disqualified next year if we are not diligent enough to keep proper documentation and ensure that invoices and receipts, that taxes are charged on them. You can see, if you get an asset and there's no import duty on it, or VAT was not collected in that asset will not be qualified for capital allowance. Even if the asset is 1 billion, they won't grant you any capital allowance because VAT was not charged on it. And it's very, very important that we know this. It's very, very important. It's a law. It's a law. You cannot say you won't obey the law. Now, let us look at another illustration I made here. The illustration is on the impact of elimination of initial allowance on the cash flow of companies. Let me read. A company acquired motor vehicle, equipment, and furniture at 50 million, 100 million, and 25 million respectively. A company acquired 3 assets. They acquired motor vehicle, they acquired an equipment, they acquired the furniture at 15 million for motor vehicle, 100 million for the equipment, and 25 million for the furniture respectively. If the accessible profit of that company is 100 million, the question is compute capital allowance and company income tax of that company using the appropriate rate based on currently CETA and also based on the Nigerian Tax Act to start implementation next year. So we are going to look at the solution. You can see the solution. This is a computation of capital allowance and company income tax based on CETA. That's currently what we are doing now. What we are currently doing now. So you can see that let me increase it. You can see that initial allowance was granted on these assets. Annual allowance was granted as we are currently computing. You can see it. And based on granting of that initial allowance, finally, if you look at our tax computation very well, the company is paying 10 million. The company is paying 10 million under SITA as currently being computed. I wouldn't go into the nitty-gritty of computing capital allowance for you. Most of you know how to do capital allowance. I'm just doing an illustration. Now, if you go to the next one, computation based on capital allowance, computation based on Nigerian Tax Act, you can see here, the Nigerian Tax Act says only one annual allowance they're going to charge. You can see it's only annual allowance they're seeing here. So no initial allowance, no annual. It's just one annual allowance on straight line basis. You can see that annual allowance here. So when you do it and go down and do your computation, you finally see that that company is paying 18,750,000. You can see when initial allowance was granted, the company paid 10 million. Now the initial allowance has been eliminated, the company will pay 18 million. You can see how the cash flow of the company will be affected. It affects the cash flow because a company would have preferred to pay 10 million, save more money as we go. But now the company is paying more because of the elimination of that initial allowance. I just did this illustration. Possibly next time I'm doing Sokoto district presentation, I will be more practical. I'm going to do more of computation. I'll do more computation on personal income tax. I'll do more computation on company income tax and all the it will be purely a computational technical session so that you can see it. But today, let us dwell on the theory, understand what the laws are talking about. Next time we'll go into the computation fully. Now, the assets lost or destroyed. What happens when asset is lost or destroyed? You look at section 43 of the Nigerian Tax Act. When an asset is lost or destroyed, the amount received as compensation is used to purchase a replacement asset within 3 years. Any difference that results in a gain will be subjected to tax. What is he saying here? If an asset is lost or destroyed, and there's a compensation on the destruction of that asset. If there's a gain arising from that compensation, that gain will be subjected to tax. It will be subjected to income tax. What if there's loss on the compensation? An asset was destroyed and it will be compensated, and if you check, it's a loss. However, we had the different results in a loss. The difference will be considered as a new asset for the purpose of computing capital allowance. You have seen it. That is what they're saying. Additionally, for the replaced asset, the capital allowance will be claimed on the proportion, on the portion that relates to the residual value of the replaced asset and shall be limited to the tax written down value of the asset. This is exactly what the treatment is going to be. Now, I want to also look at ascertainment of total profit of a company. Total profit of a company now include chargeable gains. You don't just say is the profit the company made, that other gains are not part of it. Any gain the company has made in any way is part of the total profit of the company and will be subjected to company income tax. And we have seen that how the new act redesigned capital gain tax. For me, it's not a redesign. Analysts are calling it the redesigned capital gain tax, but for me, it's not a redesign. For me, it's an elimination. Capital gain tax has been eliminated. You cannot make any gain now from next year, and they ask you to pay capital gain tax. Any gain you made will be subjected to income tax. As a company, it's company income tax. As an individual, it's personal income tax. So there's not like redesigning capital gain tax. Capital gain tax was not redesigned. It was eliminated. Formerly, if you make a gain, it goes under capital gain tax. You pay 10% and go your way. But now it's no longer like that. Any gain you are making now, income tax will apply on it. So if you look at section 4 of Nigerian Tax Act, you also see that the act exempt individual from paying gain on the proceeds of sale of his residential property. If you sell your residential property, they say you are not going to pay capital gain tax on it. So let us know that there are some exceptions or exemptions. The act also increased the compensation to 50 million. Remember that compensation on loss of job or an injury formerly is 10 million. Up to 10 million, you are not going to pay tax. But now they have increased it up to 50 million, you are not going to pay tax. Meaning that if you are being compensated in any way and the amount they gave you in the compensation is from 50 million and below, no tax will be paid. But if it's more than 50 million, you're going to pay tax. So let me ask a question. Assuming that somebody was compensated with 61 million, how much tax will that person pay? Let me see whether somebody can answer this question. Somebody was compensated with 61 million. How much tax will that person pay? Can somebody answer that question? We said that capital gain tax on compensation, if somebody is compensated, the person will not pay any tax on it if the amount they use in compensating is from 50 million and below. Now I'm asking the question, what somebody was compensated with 61 million? So go ahead and answer, Judith. Unmute yourself and answer.
Okay, good evening, everyone.
Yes.
So the person will pay the difference on that's 1.6 million.
The person, if the person was compensated with 61 million, so what do? You do 61 minus 50. That's how much?
That's 11
million. So
million. Sorry, 11
that 11
million.
million will be subjected to income tax. That is what the new law is saying.
1.1.
If the person was compensated with 61 million, the person will not pay 61 minus 50, because 50 means you are not going to pay tax up to 50. So that's 61 million, that is the difference. The person will not pay income tax on that. If it is before, the person will only pay 10% of that 11 million. But now that 11 million will be subjected under income tax. I think that's clear. Thank you very much for that. Now, another one is, let me get to the capital gains from, I have said it, that capital gain tax is exempted from sale of residential houses. It also exempted from sale of share proceeds that are less than 150 million. And the chargeable gain does not exceed 10 million within 12 consecutive months. So there's also exemption here. If you sell shares and the shares you sold is less than 150 million, there will be no capital gain tax applied. But if a company or individual happens to sell shares and the shares is up to 150 million and above, it will be subjected to capital gain tax. And again, even when you sell shares not up to 150 million, make sure the gain you made does not exceed 10 million. That means if you sell shares of less than 150 million, but your gain has exceeded 10 million, you pay capital gain, you pay there'll be a chargeable gain that will be subjected to income tax. Is that clear? Is that clear? Or should I repeat that again? Now, this rule, the capital gain here, I made it very simple. A sale of shares, there's no tax on gains made on sale of shares, except when you sell shares worth 150 million upwards. Or you sold shares, even if it's not up to 150 million, but you have made a gain that exceeded 10 million. So any of these that you have to pay tax on it. Now we also look at exemption on personal charters. Based on section 52, subsection 1 of the Act, a gain on disposal of a personal property will not be a chargeable as far as that property you are selling does not exceed 5 million. A gain on sale of personal property shall not be a chargeable gain, except if that gain exceed what? Exceed 5 million. So we should know that. Now let's go to value-added tax. The value-added tax rate remains unchanged. It remains 7.5%. You can see that in section 148 of the Nigerian Tax Act. And the value-added tax, initially, government wanted to increase it to 10% and move it from 10 to 12.5 and to 15. But Nigerians, National Assembly, the governor said, no, let's leave it at 7.5%, that Nigeria is suffering an inflation. And if you're increasing this VAT, inflation may not be controlled. And as a result, the committee and the National Assembly obeyed and kept that VAT rate at 7.5%. But again, you have a vertical distribution formula. The vertical distribution says federal government is getting 10%. Currently, federal government is getting 15%, but with the new law, federal government is getting 10%, the state government is getting 55%, and the local government is getting 35% under vertical distribution. Under horizontal distribution sharing formula, the equity is getting, or the equality is getting 50%, consumption is 30%. Formerly, this consumption was written derivation, but you know that derivation caused a lot of problems. So they changed the name and turned it to consumption. Then population is 20%. You can see this in Nigerian Tax Act section 81 of the Nigerian Tax Administration Act. And again, I want to say here that, please, Nigerians, you can see that most of these revenue generated are going to the states and local governments. I'm using this opportunity to ask us to begin to ask our local government and state government to show a level of accountability. From VAT that is being distributed now, federal government is only taking 10%. 90% of this VAT is heading to states and local government. I read this morning that the last quarter that they generated 1.9 trillion in VAT, meaning that the bulk of that money is going to states and local. And you know that most of the state governors are controlling local government funds. Despite the Supreme Court order that state governors should allow local government to be and allow local government to manage their funds, majority of the governors are still controlling the local government funds. That's a country where people don't obey law. People want to do what they want to do. So time has come as professionals, as non-governmental agencies, NGOs, civil society, to rally around and begin to ask the state governors what they're doing with this money. It's not enough to say pay tax, pay tax, pay tax. But the time has come when we professionals will also ask the state governors to show some level of accountability. Now, we also want to talk about VAT. Under the VAT, we want to talk about expanded list of exempted items. Some items were exempted and they included GENCOs, the generating companies of the electricity generating companies of Nigeria. We also have electricity trading companies. You have transmission companies of Nigeria and distribution electricity distribution schools. So some of these as exempted. And then the act also increased the number of zero-rated items. Zero-rated items. The number of, look at section 187 of Nigerian Tax Act. It increased the number of zero-rated items like basic food items, all medical and pharmaceutical products, including medicinal, herbs products, educational and books material, fertilizers, locally produced agricultural chemicals. What is these are trying to do? Formerly, these items were under exempted items, but now they moved them into zero-rated items. What's the difference between a zero-rated item and a VAT exempted item? I will explain the difference. Somebody will ask you a question now. What is the difference between VAT exempted items and VAT zero-rated items? In exempted items, if you suffer input VAT, you can't recover that. But if it's a zero-rated item, if you suffer an input VAT, you can recover that. So this is just the difference. Formerly, all these basic food items or medical, if peradventure by mistake somebody suffered VAT, you can't go to the Revenue Authority to claim it because they're exempted items. The Revenue Authority will not listen to you to come and claim refund that you suffered VAT on exempted items. But if it's a zero-rated item, if you are coming to claim refund, they will give you back because it's zero-rated. So I want people to know the difference between VAT exempted items and the zero-rated items. They also include locally produced veterinary medicine, locally produced animal feed, and all that. Now, we also talk about the big one here. The big one here is about fiscalization of VAT supplies. What is fiscalization of VAT supplies, or what people are calling VAT fiscalization? Section 157 of the Nigerian Tax Act mandates taxable persons to implement that may be deployed by the tax authority, which may include electronic devices, software solutions for electronic invoicing and data transfer. You can see that in section 23 of the Nigerian Tax Administration Act. It mandates that every person making taxable supply to adopt any electronic physical system, EFS, for recording and reporting transactions when the Nigerian Revenue Service implements such a system. A notable example is the EFS, that is the electronic physical system that has to be introduced by the Nigerian Revenue Service, is the VAT automation and e-invoicing system. Now, what are we saying here? By next year, the Nigerian Revenue Service will move to hotels, move to eateries, move to gardens, move to supermarket, and install their system. So as you are selling, your sales are recorded. You can't sell a product of, you can't sell 100 million and come and lie to them that you sold 50 million. And there's heavy penalty. If you allow them to install that system, there's a very heavy penalty on that company or that individual. So by next year, they'll be going around to install their system. And you have to be remitting their VAT instantly. You don't need to waste time. The era of hotels selling at the end of the month and they discover they got VAT of 10 million. The hotel will now say, okay, we got VAT of 10 million. How much do we even give these revenue people? Let's just give them 4 million and keep the remaining one. When they come audit, to go resettle. That era is going. By the time they install this system, you have to pay your VAT correctly. So that's what we call about VAT fiscalization. Then another one is the elimination of self-charge VAT. You know what we call self-charge VAT? Self-charge VAT means you were able to get an invoice, and when you are paying somebody, the person did not include VAT in the invoice they are paying that person. The law says self-charge yourself, self-account on that VAT, pay that VAT. Somebody is giving me an invoice for services rendered to me. By right, the person is supposed to add VAT in that invoice that is given to me. But the person mistakenly did not add VAT. The law says I should self-charge myself because I'm supposed to give him that VAT. So I can also take that VAT and go and pay. So, but the new law now is saying no more self-charge. No more self-charge. Self-charge is currently stipulated in section 14, subsection 4 of Value-Added Tax Act. You know, but I am among those who criticize the self-charge. I'm among those who told them to remove self-charge because I believe that self-charge promotes double taxation. So now, see a big one. I want you people to take this one, though, so you can write it down. This is a big one coming next year. Now, this section says any expenses which VAT was not charged, any expenses which VAT is due but was not charged, that expenses will not be qualified as an allowable deduction. You can see that in section 21, subsection P. 21P. If there's any expense of a company or individual that is due for VAT and VAT was not charged on that expenses is not an allowable expenses. Please, let's note it too. Next year is going to be tough. We have to let our clients, we have to let companies know that things have changed. Any expenses you are making, and that expense is VATable. If they didn't pay VAT, if they didn't charge VAT on that expenses, you can't claim that expenses. You can't. That's what the law is saying. And you cannot win the revenue authority on issues of law. If you like, go to court. The judge will tell you that is what the law says. So we have to start organizing technical sessions for companies, owners of companies, and start educating them on these new changes. So that they say when men learn how to shoot without missing, the birds, you learn how to fly without perching. Now let's look at stamp duties. Stamp duties. There are some changes in stamp duties. And these changes is what I want to talk about. One is the liability. One is the liability of the Okay, let me start with the change of the administration. Formerly, the administration of stamp duty lies in the hands of Federal Revenue Service. Under the Nigerian tax law, the administration of stamp duties now goes with the Joint Revenue Board under the advice of Nigerian Postal Service. So we should take note on that. So please write it down. Write it down if you have a pen with you there, that currently stamp duties are being administered by Nigerian Federal Revenue Service, FIRS. But from next year, under the Nigerian Tax Act, stamp duties will be now administered by the Joint Revenue Board, Establishment Board, under the advice of the Nigerian Postal Service. Please, it's very, very important we note that. Also, the liability for stamping has also been defined. One of the most noteworthy reforms in the Act is the clarification provided in Section 125, subsection 2(5), and the 9th schedule regarding the party liable to pay stamp duty. Formally, some stamp duties, there's no clearly who is to pay. It being kept open. Like those days, the question is, stamp duty is being paid by the beneficiary of the contract or beneficiary of the agreement. And sometimes we ask ourselves, if the government gives contract to my client, is government the beneficiary or my client is the beneficiary? Because sometimes you don't know who pays the stamp duty. If somebody goes and pay rent, is it the tenant that's supposed to pay stamp duty or the landlord supposed to pay that? Who is the beneficiary of the rent? Is it the tenant that is enjoying the accommodation, or is it the landlord that is enjoying the money the tenant paid? So the stamp duty made it very clear now, those that will pay, who is liable to pay. For loans is the lender. I have a situation where one of my clients collected a loan. He was forced to pay the stamp duty. But now, moving forward, he's not supposed to pay. He's the man that lent that money to the company. The company that lent the money is supposed to pay, because the company that gave that loan is the one benefiting, because the company that gave that loan is the one making interest on the loan. So it's the beneficiary. So for lease, it said the leasee, that's the tenant that is enjoying, is the beneficiary. For transfer of property is the leasee, is transferee, and for guarantees is the guarantor. Let me enlarge the stamp duty for you to see. You can see the agreement, the types, the rate, and the persons that is responsible for agreement of our contract or company. The rate is 0.35%. The person liable is the mortgagee for mortgage. You can see all of them here. You can see what they are saying. You can go through this table. The table will show you who is to pay, the rate to pay, and transaction that is involved. But there's one thing that is very, very, very interesting in this stamp duty. The interesting thing is that contract, under our current law, contract is 1%. So when the ministries or agencies happen to give our client contract, they'll take 1%. But now, under contract, they brought contract under the fixed rate of 1%.
Doctor.
Yeah.
Sir, please, we just have 10 minutes more, so that we have enough time for question and answer. Please, sir, maybe you can just help us round it up. We have just 10 minutes so that we can start question and answer.
Okay.
Thank you very much.
Okay,
Sir.
Okay, thank you very much. I will quickly point out one or two places under stamp duty. These are chargeable instruments under stamp duty. These are instruments that are supposed to be charged. So you should know the instruments that are chargeable. I will leave this paper with 2 people. And these are items exempted from stamp duty. These are exemptions. It's not everything that's supposed to be on stamp duty. So these are exemptions on stamp duty. So when you get the paper, you can easily know the exemptions on the stamp duty. Then we also go into digital assets quickly before my time is running out. This is a very interesting paper. I wish you have more time, but my time is running out. Under digital asset, before now, there's confusion over how those doing digital businesses will be paying tax, especially those who are into so many activities online, even including cryptocurrency traders. But now, the digital assets are going to be charged as income tax. We talk about relief from double taxation. Nigerian Tax Act Section 121 provides for a unilateral relief for taxes. If you have suffered tax in Israel or in America and come here, say you have suffered tax and the revenue authority confirm, you will be relieved of that tax you have suffered there. Unlike before, if you suffer tax there and come here, we say, no, we don't have double tax agreement with that country, so therefore we have to pay that tax again. So now, whether Nigeria have double tax agreement with the country you suffer tax or not, once there's evidence you have suffered tax in that country, unilaterally you'll be given relief from that tax you have suffered. And I think that there are more to it. And I think I better stop here and you read the paper. Possibly when questions are coming, I'll be able to answer that question because I have to obey my people. We don't have time. And I know that when questions are coming, we're going to spend more time. Thank you so much, everybody, and God bless.
Thank you very much, Prof, for a well-delivered lecture. Please permit me to say, let's give it to a man who sabi. Honestly, we have gotten what we wouldn't have got if we had to go to school for a semester. This lecture is more than what we can get for a full semester in the school. And exactly. Prof was able to give it to us within 2 hours. Please, permit me once again. We hereby give it to the man who sabi. Thank you very much, Prof. We are here for the question and answer. Please, if you have a question, you can send it through question and answer booth. That is on the chat booth. Also, you can signify your hand up so as to enable us present your questions, and Prof is here to answer any question presented by you. Thank you very much. Prof, once again, we appreciate you.
Thank you, my brother.
Please, questions. We have some questions presented on the chat booth before now, and we are awaiting others that will present their questions.
So that we, if you can read some of them out one by one.
Sir, can you permit me to read some of them for you, sir?
Read it out so that I can respond to it immediately.
Okay, thank you, sir. Please, we have a question from Obafemi. The question goes like this: how will this rent relief be treated? Can we accept rent agreement paid 2025 for 2026 payee calculation? That is a question from Obafemi, sir.
Okay, the implementation of this law will be next year, 2026. So it's rent you have paid in 2026 is what you are going to bring evidence. Either you bring evidence of the rent you paid or the rent agreement, which will be used in filing in 2027. Remember that the first set of accounts we are going to file under this new law will be under 2027 accounts, 2027 returns under 2026 account. No, 2026 account return will be returned in 2027. So is the rent that we paid in 2026 for 2027 returns.
Thank you, sir. Mr. Obafemi, I think you get it, and others who will be interested in the same question. Also, we have a question also from Mr. Obafemi, stated that How will this gain made on personal sales on shares reinvested be treated?
Yeah, if you made sales and you reinvested it in the same shares, it will be exempted from the within the 12 consecutive months of the year. You will be exempted from the capital gain, from the chargeable gains. But if you don't reinvest it in the same shares, maybe you go and invest it in another thing, you're going to pay capital gain on it too. You're going to pay income tax on that gain. So you have to be sure that you are investing in the same security where you made the gain. And it's very, very clear that when you sell, you shouldn't sell up to 150 million, and the gains you made should not be more than 10 million. Is that clear? I hope that question has been answered.
Mr. Obafemi, please, I think you understand Prof's answer to your question. Please, we are awaiting your hands up if you have a question. We have a question from Bilkis. Goes like this. Please, I don't get the clarification on allowable deductions and VAT on as explained by Dr. Prof, and how section of NTA specified it.
Okay, let me explain more. When a company is running her expenses, for example, you are paying for services. Let's say you are paying for audit services. When you are paying for audit services, the auditor is supposed to give you an invoice and charge you VAT on that audit services. If you are paying for legal services, if you are paying for other services and supplies, the company you are paying or the individual you are paying supposed to add VAT and give you the invoice. Now, the law is saying that if that individual did not charge VAT on that supplies, on that services that will be rendered to the company, that services, that audit services, that legal services, those supplies will not be an allowable expenses. Is that clear? If a company hires me as an auditor and is paying me my audit fee of 1 million, for example, when I'm giving that invoice to the company to pay, I won't put only 1 million. I'll put 1 million plus 7.5%. I'll give them as invoice. So the company will pay me 1,075,000 and record it as an expense in their books. So when the revenue authority comes and say that there is VAT in that audit services, they will allow it as an expense. But if the revenue authority came and say that it's only 1 million that I didn't collect VAT, they won't allow them to use that 1 million as an expense. That 1 million will not be an allowable expense. Is that clear?
Thank you very much, sir. We have a question from Seyi Adedeji. Please permit me to read it out, sir.
Go ahead.
Okay, sir. Sorry, sir. He say, well done, Prof, for a well-delivered lecture. He wants a clarification under the new payee. Is it only rent that now qualifies for a relief since there is no longer CRA?
Yeah, we also have other forms of reliefs, like you have other deductibles, like the pension. You have other Nigerian Housing Fund. You have the insurance premium. You have the mortgage interest. You have other reliefs. But what they did was to replace rent relief with they replaced consolidated allowance relief with rent relief. That's what they did. Other deductibles are there. What they simply did is that there's no more consolidated allowance, which is 20% plus 200,000. They just eliminated it and replaced it with rent relief. But other deductibles, PENCOM, as far as the organization registered you with PENCOM and they are remitting pension on your behalf, it's an allowable deduction. A National Housing Fund, National Health Insurance Premium, mortgage interest, and all those. So those other ones are there. So the rent relief is a replacement of consolidated relief. Thank you.
Thank you, Prof, for the explanation. We have a question from Hakeem Olarewaju. Why is it that basic food items are subjected to 0 VAT, while processed food are subjected to VAT? That's a question for you, sir.
Yes, basic food items don't have much. The drafters of the law believe that value has not been added to it. For example, if you go to your farm and happens to get yam from your farm, it's a basic food item. So that's why they place it 0, so that if you suffer VAT in that case, you can recover that VAT you suffered. You are not supposed to suffer VAT, but if eventually you suffer VAT, you can recover. But when you process that yam, possibly you fry it or you use it in another form, you have added value. In that case, it becomes VATable. Is that clear?
Thank you, sir. So we have a question from Mr. Samuel Emeka. What will be the effect on the rate of interest on loans if the lender will pay the tax on loan?
I really don't know what will be the effect of loan. Maybe the person who asked question is suggesting that now they have transferred the stamp duty to be paid by the lenders. Possibly lenders will increase their interest on loans. Possibly that could increase interest on loan, but it all depends on the percentage. If you go to that table I presented there, you can see the amount of stamp duties that will be charged on loans. But again, it's clear that the law has made it clear that it's the lender who is making interest income on that loan that's supposed to pay stamp duty, not the person that is paying you interest that's supposed to pay stamp duty. So, but I believe that if the rate doesn't impact much on the loan, the lender may overlook it. But if the stamp duty is impacting heavily on the interest is making from that loan, I'm sure lenders will try a little bit to increase the rate of interest. Thank you.
Thank you, sir. We have a question from Dennis Okutu. Please, can you unmute yourself and ask your question?
Okay, good evening, Prof. Thank you for your lecture. Confirm you are hearing me.
Thank you, my brother.
Okay, so my question is this.
Yeah.
The professional services, the services rendered will now be subject to they will subject to tax. I'm sure it's the value added tax. I want to be guided with that. Is it value added tax? That
no,
for example.
Go ahead.
For example, as a consultant, you do a service for a client. You put an invoice and definitely put a VAT. Now, after that, are you going to be subjected to any other tax after the VAT?
No, normally as a consultant, when you are sending your invoice, you're supposed to add VAT. You're supposed to charge VAT. Now, when they are paying you, when the company is paying you, the company is supposed to withhold tax from the money they are paying you. Formally, the withholding tax is 5%. Professional service, I think professional service is still 5%, or you can check the rate whether it's 2% or 5%. Now, assuming that you are giving your client a professional fee invoice of 1 million, let us put a figure to make it more explicit. Now, if you are giving your client a fee of 1 million, what we are saying here is that you don't just give them invoice of 1 million, you add VAT to it and give them, add 7.5% to that 1 million. So the invoice you are giving to your client will be 1,075,000. Now, your client, while paying you, we now remove 5% withholding tax from the 1 million of your fee. If they remove 5%, that should be how much? 50,000, B. So if you remove 50,000 from 1,075,000, they will now pay you 1,025,000. So the 50,000 they have deducted from your fee, they will use your TIN number, they use your taxpayer's identification number and pay that withholding tax for you and give you evidence of the payment. So that when you're filing your own return, you can now use those withholding taxes your client have deducted and filed to offset your income tax. In fact, that is what I do to some of our firms. Most of our firms, I encourage our clients to deduct taxes. At the end of the year, I gather all our withholding tax and use it to file income tax. Is that clear?
It's clear. Okay, this deduction of withholding tax of 5% will not go to state because most of the
it goes to the state where the auditor is residing. If you are residing in if you are residing in Lagos State, you have to let your client.
I understand. Now, the next question is, we are talking of ease of doing business.
Yes.
On this stamp duty, like the loan, somebody asked a similar question. The bank now will one bank is giving you a loan, they will charge you management services. 1% this, 1% this.
Yeah.
Don't you think bank now will technically charge you to recover that stamp duty you are paying on your behalf? And we are talking of ease of doing business. How is this law? Is it now good for business? Because the businessman who would go to the bank will not pay more. The bank will agree to pay they will suffer the stamp duty, but they will incorporate it into as a cost to you, who eventually indirectly will be paying it, not the bank too. I don't know whether you get my point.
Yes, I understood what you're saying. Absolutely. You are 100% correct. But I want to let you know why the drafters of the law made it so. I'll tell you my experience. I have two sister companies that we are consulting here in Abuja. One, company A gave loan to company B. So when FRS came to audit company B, they saw that loan and charged stamp duty on that loan. Then another time, they went over to audit company A that gave that loan. They saw that loan again and charged the same company A. So I was angry. I said, you saw this loan in company B given by company, you charged stamp duty. You're now auditing company A. You still start charging stamp duty on company A. So who is supposed to be responsible for this stamp duty? You cannot collect stamp duty for both companies, both the lender and the borrower. It's not going to be possible. I think some of these controversies are making them to not clarify who is supposed to pay. I'm sure what they did is to clarify, say, no, it is the lender who is now gaining interest on this loan is supposed to. But I agree with you that it will affect, it will make those who are lending to increase their rate or do any other thing to cover up with their money. Thank you.
Thank you very much. Finally, on the shares,
Mr. Dennis.
Sorry, sir.
Please, because of the time.
Yes, I just have the final one. Finally, on the 50, on the 150 million.
So that we can allow other people to.
I'm finishing now. Can I just ask this last one?
Okay, thank you. You can go ahead.
Okay, thank you. On the 150 million of shares you sell before, and assuming you sell a share of 150 and you make less than the 10 million profit, no issue. My question is that, don't you think people will technically sell shares when they discover that their interest is about to hit 10 million? They will stop.
Yeah,
and is this 150 for a full period of one year, or if I have say 200 million shares, or
it's 1 year. It's 1 year. It's 1 year.
Okay.
They made it clear. 12 months. They made it clear.
12 months. Okay, so I can technically sell my share once my profit is hitting 9.9 million. I stop.
It's left for taxpayers to. I said it here that if men learn how to shoot without missing birds, you learn how to fly without birds. So taxpayers to understand how these laws operate, so they can also bring technicalities on how they will survive about it. Thank you so much.
Exactly. Thank you very much. Appreciate it.
Thank you.
Thank you very much, Prof, and thank you, Mr. Dennis. Questions also from Alhaji Sulaiman Ismail. Please, can you unmute yourself and ask your question?
Thank you so much. Prof. Kennedy, you are welcome back again to Sokoto. You have really done justice to this.
Thank you, sir.
Actually, it is one of a member that sent the question to me. I don't know whether Professor Kennedy have seen it in his
Go ahead
WhatsApp.
and read the question. Go ahead and read the question.
Okay, it was a voice note the person sent to me, or maybe I can play it if it can be clear to people.
Play it and let's hear the voice note.
Facilitator, doctor, thank you so much.
Can we hear?
Yeah, go ahead.
Yes, we can hear you.
My questions are this one on the personal income tax, where you spoke about landlord, that the landlord will not be allowed to deduct rent, to be paying rent. You know, this rent will not be chargeable income to only a tenant. So what if I'm a landlord now, I have a house? Then that means I cannot enjoy the rent I live. Then the house I'm living, the person is living in. The person will be maintaining the house. Sometimes there could be maybe plumbing work, electrical refurbishment, and all of that. How would those kind of landlord or employee will enjoy from personal income tax?
Yeah.
That's aside. Then number two, we discussed that if somebody is a diplomat, for emolument of Nigerians outside the country who are like representative to the maybe countries, their taxes will be deducted. If it's not deducted in the country they are serving on behalf of Nigeria, to be deducted here in Nigeria. What about politicians? Why aren't they being charged for their own taxes? Although they seek to make laws, but those who are in the diaspora, like diplomats, they will be going there to serve the nation and make sure that the Nigerians, as in the citizens that are in that country, are well monitored, or they are okay. Why would politicians in Nigeria not be taxed and diplomats in other countries be taxed according to the new tax laws? I just want a clarification. If you can give us, maybe you take it up for us. Thank you, sir. Then the third one, concerning chattel, stamp duty, can you please brief more on that stamp duty, sir? Because we're talking, then this capital gain on tax share proceeds, if it's above 550 million, is it in per share, 150 million, that's 1 year per share, or just the total sum? Maybe is it the nominal share capital, 1 naira per share, or like if the share price is 50 kobo per share, which one are they referring to from the new tax law? Is it maybe at 1 naira per share, or maybe lesser, or just that if the figure is 150 million at the market value? Thank you, sir. My name is Kemi Ademuyiwa. I can move on the Street Society and report to 636. Thank you, sir.
Yeah, thank you. Thank you. I think all of us had the 3 questions. Let me quickly answer them. The replacement of rent relief shows that they don't want landlord to benefit from the relief. It's very clear. The body language of the law shows that they just want to grant relief to those who are paying rent, not landlords. So if you're a landlord, you are not qualified for rent relief because landlords don't pay rent. Even for those who pay rent that want that rent relief to be granted, they must bring evidence of the rent they have paid or rent agreement for the revenue authority to grant them that rent relief. That's number 1. I don't know why they removed the consolidated relief, because that time is being granted to everybody, whether you're a landlord or tenant. Remember that the consolidated relief is 20% of total earned income plus 200,000. Assume that your income in a year is 10 million, for example. Your consolidated relief should be 20% of the total earned income, which is 2 million plus 200,000. That means if you have earned 10 million in a year, you have a consolidated relief of 2.2 million based on the current law that is being practiced. But they have removed it and said that they only grant you a rent relief and it cannot pass 500,000 as a threshold. So my answer to that is that the drafters of the law don't care whether landlord is maintaining their house or not, or there is repairs and maintenance in their house. All they are saying is those that will benefit from the rent relief is only the tenants. Then number two, he said that those who are working abroad, why is it that their allowances that that is not taxed abroad will be taxed in Nigeria? Why politicians are not being taxed? I disagree with you. Politicians are being taxed too. All the allowances paid to politicians officially, they are being taxed, and every year politicians get their tax clearance certificate, except if there's any money they made outside the official salary that is not genuine money. You can claim that that one has not been taxed. But I'm sure the money paid to all our politicians, either as ministers, either as senators, House of Representatives, all the official money, all official emoluments are being subjected to taxes, and I'm sure I've been witness to that. They get their tax clearance certificate every year. But any income they are not paying tax, possibly that income must be a suspicious income. Now, the last one is shares. Is saying, how is the shares? Is it per share? Well, it's not per share, it's the volume. What is the amount of shares at the end of the year? How much shares have you sold at the end of the year? How much gain have you made of the year? Nobody's interested in whether it's per share, just the totality, the total value of the shares you have sold and the total value of the gain you have made is what the law is looking at. Thank you very much.
Thank you, Prof, for the well-explanatory on these questions. We only have one hand, and that is all the question we take now. The question is from Mr. Matthew Anila. Thereafter, please, if you have any other question, you can get in touch. You can send your question to iconsocotodistrict@gmail.com. There will be a justice will be done by Prof, and we'll get back to you on the solution to your problem or to your questions. Please, Mr. Matthew Ainla, you can unmute yourself and ask your question.
Thank you very much.
Thereafter, we continue. Thank you.
Prof, once again, I want to thank you. I just want to seek a simple clarification as to the accessible profits, which you made mention. Are we now saying the accessible profit now, the accessible tax, which is after the normal CIT, which we normally do our tax, 3%, is now 4%? Because I know you have shown us the breakdown and how it is to be utilized. Is it now 4%? Or I didn't pick that right?
No, what is 3% currently? What we are currently doing 3% on the accessible profit is the education tax, state fund. No, when you are doing your tax computation, you compute for state fund education tax at 3%, and your CIT at either 0%, 20%, or 30%. Is that clear?
Yes.
Now, they have abrogated that state fund, that education tax of 3%. What they are now doing is development levy of 4%. But when they do that development levy of 4%, from whatever they collect from 4%, state fund will now get 50% of it, and other agencies will get 10, 15 as they have listed them. This is the new way going next week.
Okay, so the clarification I'm making is this 4% has now replaced the 3%, which will
it has replaced the 3%, and formally the 3% is education tax. Now the 4% is development levy.
Development levy. Okay, that's it. Thank you very much.
Thank you very much.
Moderator, please.
Hello. Okay, thank you very much, Prof. We appreciate your gesture in giving us this a solution to a problem that has been hanging on the sky for long.
Yes.
Thank you. Thank you all.
Thank you very much. The next time we're going to do this technical session, we'll make it practical. We'll do more of computation. I'm going to bring an ID questions for personal income tax computation, for company income tax computation, to be figures. We're going to play on figures. And I also want you people to expand your webinar. I discovered that your webinar can only take 100 people. A lot of people want to join. Next time, expand your webinar. I can accommodate 150, 200, so that so many other people across the country can join you, as your district is making a very big wave. Thank you so much, and God bless.
Thank you very much, sir. Observation noted, and we try as much as possible to work on it. Thank you for the love for Sokoto and the district. We are very glad and happy to have you as one of our patron. As let me just say that one. Thank you all, to all our speakers for sharing your experience, your questions, your participation. We hope you find this webinar informative and valuable. Thank you very much. Vote of thanks will be taken by our district coordinator, Dr. Kingsley Ayonze. Doctor, please, I don't know, maybe you are available to take the vote of thanks. Hello, doctor. Okay, please, Mr. Ismail.
Yes, Mr.
Ismail, please help us to give the vote of thanks. It's like a doctor is not presently available.
Thank you so much. Good evening, professional colleague. Once again, I would like to appreciate our speaker, Dr. Kennedy. But let me just respond to something he said before the proper vote of thanks. Prof, I want to let you know that we have over 200 people that attended today's webinar, because we are streaming it live on our YouTube page. So as the thing reaches capacity of 100, it automatically takes you to YouTube and it is live.
Okay, that's good.
And it has been monitored by my humble self and the chairman and the technical secretary. We have about 110 people that stream live, apart from the 100 on the Zoom platform.
Okay, thank you so much.
That's to show you that we are all over the world, sir. Thank you so much. You cannot have it less from Sokoto and this.
Thank you very much, Mr. Suleiman. Hello? Hello, can you hear me?
Loud and clear. Moderator, we can hear you.
Of allowing. All right, thank you. We thank God Almighty for allowing to this event. Has allowed it to come to pass. Leaders who have in their quest to ensure that Sokoto is giving value to all our members across the globe. And most importantly, we thank our RC Professor Kennedy, because he has been a friend to the district. He always answers us, even when we call him in a just impromptu, he always answers us. We say thank you for coming. We appreciate you. We are assuring you that we always partner with you here in Sokoto and this society. And I thank all our members that have joined across all districts, across the globe. We appreciate you, because if we bring the webinar out and Prof is there to deliver and nobody comes there to join the webinar, we'll just be on our own. So I appreciate each and every one of us. I pray that God will continue to be with each and every one of us. And I assure you that all of us will get our 2 credit hour as soon as possible. Thank you. God bless you all.
Thank you very much, Mr. Ismail. Presentation of award by Mr. Chairman. Mr. Chairman, can you kindly help us present an award to Prof on behalf of the Sokoto district?
Hello?
Yes, we can hear you.
Oh, okay. Good evening, everyone. Professional colleague from Nigeria and across the world. Thank you so much for joining us this evening again. So on behalf of Sokoto and Dusi Society, this is just a little token of appreciation from us to the Prof. As you can see on my screen, this is the plaque that we're presenting to Prof. Virtually, and the hard copy will be delivered to his office. Prof has been a standing professor right from in-time memorial to Sokoto and District Society. We just hope to receive you physically so that at the seat of Caliphate, you'll be able to get you some of those traditional and all those things in our vicinity here. Thank you so much, Prof. And as you said, I will look forward to the next webinar, which is going to be practical, and then we'll promise you that that practical is going to be interactive. And let me use this opportunity that as Prof promised, the practical will come with solution and is going to be interactive. Sokoto and District Society will also make available the gift and the prize to the winner of those interactive discussion. So, and we have on this note, let me hand over back to our technical secretary to pass some of the announcement that we have to the audience. Thank you so much, Prof. And over to you, please.
Thank you, Mr. Chairman. Announcement, please. We have the following announcement. We have another webinar on August 23rd, 2025. Kindly subscribe. Please be ready to join us August 23rd, 2025. Also, please, you can subscribe to our handle at Icon Sokoto District. Thank you very much. You are all welcome. Secretary, can you help us? Can you give us the icon item?
Okay, thank you very much. On it.
Let's go, like and fountain of treasure in triumph of an array, standing stronger in harmony, building our land together. Dreams of a founding fathers, we are striving to attain our roots and values that we share through all ages be sustained. Institute of Chartered Accountants of Nigeria. Your accuracy we cherish. We uphold your integrity.
Thank you very much. Thank you, everyone. Let's enjoy the rest of our weekend. Happy rest of the weekend. Thank you very much. Have a nice weekend ahead.